Welcome to Griffonomics.
It's great to be here.
Today is Thursday, February 12, 2026. And, well, if you've been glued to your screens watching the markets for the last, 48 hours?
Yeah, last couple of days.
You have probably seen a sea of red, specifically around a name that's, it's usually the boring, reliable bedrock of the financial world. We're talking about S&P Global, ticker symbol SPGI.
It has been a brutal week for the stock.
Yeah.
I mean, there is really no other way to put it. A tough week.
Brutal is the right word. The stock plummeted, what was it, about 17% in pre-market trading earlier this week?
A huge move for a company of that size and quality.
And here's the head scratcher. This is the thing that I think is really confusing a lot of retail investors out there. They actually beat revenue expectations. They did. They brought in $3.92 billion for the quarter. So, I mean, the cash register is ringing, but the market took one look at the report and just absolutely hammered them.
Well, it's a classic example, isn't it? The market is a forward-looking mechanism.
Right. It's always about what's next.
Investors don't pay you for what you did yesterday. They're paying you for what they think you're going to do tomorrow. And yeah, S&P Global beat on the top line on revenue.
Which is great.
But there was a tiny earnings miss. And I mean tiny. We're talking 4 cents here.
4 cents, that's it.
4 cents. But then, crucially, the guidance. Management came out with what they called a prudent outlook for 2026.
Ah, the dreaded prudent outlook.
And unfortunately, the market interpreted prudent as disastrous.
Right. And that disconnect, that gap between a solid business and a panicked market reaction, that is exactly what we need to unpack today.
Absolutely.
Because on the surface, you see a 17% drop and you think, okay, the business model is broken. Something is fundamentally wrong here.
Which is a natural reaction.
Of course. But our mission today is to look under the hood. We aren't just analyzing a single quarterly report here. We are analyzing the transformation of a massive legacy conglomerate into what is effectively a pure play, information utility.
That phrase, information utility, that's it. That's the thesis statement for this entire deep dive. It completely changes how you value the company.
Exactly. So we've got a massive agenda. We're going to dig into the spinoff of Mobility Global that's happening later this year.
And why it changes the math.
Why they're doing it, how it changes the math. We're going to look at the transparency gap in private markets, which is apparently a $21 trillion opportunity.
Staggering number.
And we're going to have the hard conversation about the AI war. Is artificial intelligence going to kill their business model? Or, have they built the ultimate defensive mode?
That is the existential question for every data company on the planet right now.
So let's start with that concept you latched onto, the information utility. When I think of a utility, I think of, the electric company.
Sure.
I flip a switch, the lights go on. I don't shop around for electricity every morning. I don't negotiate the rate with my toaster. It's just there. It powers everything.
That is the perfect analogy. It's perfect. And that is exactly what S&P Global has become for the financial ecosystem. If you're a bank, an asset manager, a government, or a major corporation, you essentially cannot function without their data.
You can't function.
You really can't. It isn't a luxury item that you cut from the budget when things get tight. It is the plumbing.
The plumbing of the global financial system. I like that.
Precisely. And here is the statistic that really drives this home. It came up repeatedly in their Investor Day materials. Over 95% of their revenue comes from proprietary benchmarks, data, and tools.
95%, that is a staggering number.
It's incredibly defensive, and the implication is profound. This isn't public data. This isn't stuff you can just, scrape off the internet or find on Google.
Okay, so this is key.
This is data that is proprietary to them, often created by them, and in many cases, hard-coded into the regulations and contracts that run the global economy.
So, just to be super clear for everyone listening, if I'm a hedge fund manager, I can't just ask my AI assistant, hey, give me the official S&P 500 beta for my fund, because my AI doesn't own that index. S&P Global does.
Correct. Your AI can tell you what the S&P 500 is, but it cannot be the official legal benchmark for a billion-dollar ETF. That distinction between public data and proprietary essential intelligence is the firewall. Is what protects their margins.
So they're not really competing with the open internet.
Not at all.
They're competing in a walled garden where they own all the plants.
And not only do they own all the plants, but the regulators have effectively put up signs saying, you must eat these plants to survive.
Wow. Okay, let's get into the engine room then. Before we get to the drama of the spinoff and the earnings miss, We need to understand the machinery here.
The moving parts.
Right. Historically, we've called this the Big Five segments, but that's about to change to the Big Four. So let's walk through them, starting with the anchor, S&P Global Ratings.
This is the legacy business, the original. They are the world's largest credit rating provider. And when we talk about economic moats, this is as wide and as deep as it gets.
Explain that moat to me. Because logically, I could start Griff's rating agency tomorrow. I can read a balance sheet. I can give a company a grade. Why can't I disrupt them?
You could certainly try, but practically speaking, nobody would care about your grade.
Ouch.
The moat here isn't just reputation, it is regulatory. These assessments, the credit ratings, are literally hard-coded into financial regulations all over the world.
So the government requires it.
Effectively, yes. If an insurance company wants to hold capital, the regulations often say they must hold bonds with a specific rating from a recognized agency. You can't just make one up.
So it's not just that the market trusts S&P. The law effectively requires them to use a major rating agency if they want to play the game.
It is an oligopoly with a regulatory floor. Simple as that. If a company wants to issue debt, which, almost every major company does, they generally need a rating.
And if they don't get one?
If you don't have one, you pay a massive penalty in interest rates, a huge penalty. Or you just can't sell the debt at all.
So you're forced into their system.
You are. And because of that entrenched position, the economics are incredible. We are talking about operating margins north of 60%.
60% margins. That is effectively a software margin on a services business. That is a money-printing machine.
It really is.
And what I find fascinating is this issuer pays model. The company borrowing the money is the one who pays S&P to rate them. That's always felt like a bit of a conflict of interest to me.
It creates a tension, certainly. The regulators watch it closely. But the market has accepted it because the alternative investor is paying for ratings. It just leads to a free rider problem.
Where one person buys the report and just emails it to everyone else.
Exactly. So the issuer pays and S&P maintains its credibility because if they lose that reputation, they lose the entire franchise. The whole thing collapses.
Okay, that makes sense. Next up, the one everyone knows, S&P Dow Jones Indices.
The cash cow. S&P Global owns 73% of this joint venture. They manage the S&P 500 and the Dow Jones Industrial Average, the two most important benchmarks in the world.
And this is my favorite business model in the entire portfolio because they don't actually manage the money, do they? They're not BlackRock or Vanguard.
No, they don't touch a single dollar of the assets. They don't have to hire traders or worry about risk management. They just provide the ruler. They provide the ruler that measures the assets.
But they get paid based on the assets measured.
That's the beauty of it. They earn asset-linked fees. As passive investing grows, as more and more people dump money into S&P 500 ETFs like SPY or VOO, that money flows into funds linked to their indices.
So if the stock market goes up, their revenue goes up.
Yes. And if more people save for retirement and invest in index funds, their revenue goes up. And the margins here, they're even higher than ratings.
Higher than 60%.
Oh, yeah. They report margins above 65%, sometimes touching 70%.
How is that even possible?
Because it costs them essentially nothing to add another dollar of assets to an index.
The work is already done.
That is the definition of operating leverage. The algorithm is already written. The rules are set. Whether there's $1 billion or $1 trillion tracking the S&P 500, the cost to S&P Global is virtually the same. The incremental margin on that next dollar is almost 100%.
It's almost like a royalty on the American economy. If America grows, S&P Dow Jones Indices gets a check.
That is exactly what it is. It is a royalty on global capitalism.
Incredible. Okay, third cylinder, Commodity Insights. Or I think they're rebranding this now.
Yes, they're moving toward calling it S&P Global Energy. This is largely the legacy Platts business.
Platts, I've heard that name. They do oil prices, right? Brent crude and all that.
They do. But it is so much more than just reporting the price you see on the news. They provide daily price assessments. For example, Platts dated Brent.
What's special about that?
This isn't just a news ticker price. These specific prices are used to physically settle contracts and derivatives all over the globe.
Wait, walk me through that. So if I'm, say, an oil tanker company and I'm selling 1 million barrels of oil,
Yep.
The actual check I get is determined by the number S&P Global publishes on that day.
In many, many cases, yes. The contract between the buyer and the seller will literally say, price to be determined based on Platts dated Brent on the delivery date.
So again, it's not a choice. It's the utility status.
It returns to utility status.
Yeah.
You cannot trade the physical commodity effectively without an agreed-upon third-party benchmark. S&P owns the language of that trade.
They are the referee in the middle of the scrum.
Exactly. And in volatile markets, like we've seen with the energy transition and geopolitical conflict, people need that referee more than ever. The demand for trusted pricing just goes up.
It connects back to that theme. They own the language of the market. Okay, fourth one, market intelligence.
This is the workhorse. It's the biggest contributor to revenue, roughly a third of the total pie.
33%.
This includes their flagship product, Capital IQ Pro, its multi-asset class analytics.
So this is the stuff that competes with, like, a Bloomberg terminal, right?
To an extent, yes, though they serve slightly different niches. You could say Bloomberg is very focused on the trader, the execution, the real-time news. S&P Market Intelligence is very focused on the analyst, the investment banker, the corporate strategist.
The deep research.
The deep research, exactly. It's primarily subscription-based. It's data, research, and analytics for banks, investment managers, and universities. And this is the segment that's currently undergoing the biggest transformation, specifically targeting private markets, which I know we'll get to.
We will. And finally, the outlier, the one that caused all the noise this week. Mobility.
The outlier indeed. This is the automotive data business. They own brands you've heard of, like Carfax and Mastermind. They serve OEMs, the car manufacturers, and the dealers on the ground.
And just looking at the numbers, you can see why it's the odd one out.
It is a good business, don't get me wrong.
Okay.
Carfax is a fantastic brand. I mean, everyone asks for the Carfax report when they buy a used car.
It's a verb. Did you Carfax it?
Exactly. But the business model is cyclical. It's tied to car sales, to interest rates, to the health of the consumer. And the margins, while healthy for a normal company, are significantly lower than the rest of S&P.
We're talking around 40%, right?
It's around 40%.
Lower. Only 40%. Most companies would kill for 40% margins.
In the rarefied air of S&P Global, 40% is a drag. It's an anchor. When your other businesses are humming along at 60, 65, 70%, a 40% margin business is actually pulling your average down.
And that leads us directly to the strategic inflection point we are facing in 2026.
The spinoff.
Let's unpack this, because this isn't just a rumor anymore. We got hard confirmation in the Q4 update.
We did. It's official. It is on track for mid-2026, and the new company is going to be called Mobility Global.
Not exactly winning any awards for creative naming there, are they?
Simple is usually better in corporate spinoffs. Keep it clear. They already named Matt Calderon as the CFO designate.
So leadership is in place.
They filed the Form 10 confidentially with the SEC. And we should expect a public filing and a dedicated investor day for the new company sometime in Q2 of this year.
So this is happening. The train has left the station. Let's talk about the why. Why get rid of a business that makes 40% margins and owns a household name like Carfax? Is it just about the numbers?
It really comes down to two key things: margin accretion and valuation unlock.
Okay, let's do the math on the margins first. Margin accretion.
As we just discussed, Mobility operates at roughly 40% margins. The core financial businesses, like ratings and indices, are at 60% plus.
Right.
By mathematically removing the 40% margin business from the consolidated financials, the remaining S&P Global entity sees an immediate structural jump in its average margin.
So overnight, S&P Global becomes a more profitable company on a percentage basis.
Exactly. It's just simple math. It becomes a pure financial intelligence powerhouse. It looks more like a high-margin software and data company and less like a sprawling conglomerate.
And that leads to the second point, the valuation unlock. The theory here is that the market currently applies a conglomerate discount.
Right. Investors get confused. They look at the company and ask, wait, are you a car data company? Or are you a bank reading company? Why do I own both in one wrapper?
And because they're confused?
Or because the businesses don't perfectly overlap, they just pay less for the stock. They apply a discount because of the complexity.
Or they just don't want the exposure to the auto cycle. I mean, if I am an investor and I want to buy S&P Global for its steady recurring financial revenue, I might not want to worry about how many Ford F-150s were sold last quarter.
Precisely. By spinning it off, the remaining company becomes higher growth, higher margin, and less cyclical. It cleans up the story. It makes the pitch to investors much, much cleaner.
What about the money side of the transaction? Is S&P getting paid for this? How does the capital structure work?
Indirectly, yes. Mobility Global is going to raise its own debt. They're targeting an investment grade rating for the new independent company.
And that debt.
That debt raise will likely be used to pay a massive dividend back to the parent company, S&P Global. before the split. Or it simply transfers a portion of the existing leverage over to the new entity. Either way, it cleans up S&P Global's balance sheet even further.
And there was a note about the dividend recently. They raised the dividend, but it was tiny.
It was a 1% increase, and this marks the 53rd consecutive year of increases, so they kept the dividend aristocrat streak alive, which is important to them.
53 years is impressive.
It is, but 1% is very low for them. Very uncharacteristic.
So why so stingy?
It's a recalibration. It's all part of the plan. They are about to lose the cash flow from the mobility business, so management is being prudent. There's that word again. And they're resetting the dividend payout to match the future, smaller but more profitable footprint of the company.
Got it. So they're bracing for the amputation, essentially. They're right-sizing their promises now.
That is a graphic way to put it, but yes, they're right-sizing the capital structure.
Yeah.
It makes perfect sense, even if income investors were hoping for a bigger bump this year.
Okay, let's pivot. Let's pivot to the topic that I know a lot of our listeners are obsessed with, the robot war, AI.
The battleground.
There is a massive debate raging right now about whether AI is a death sentence for S&P Global or, the greatest thing that ever happened to them. Let's start with the bear case. The gloom and doom scenario. They call this agentic erosion.
Right. This is the fear. This is what keeps investors up at night. The argument goes like this. S&P makes a lot of its money, specifically in the market intelligence segment, by selling seats.
A license, a login to Capital IQ.
Exactly. You pay for a login, and a human analyst sits there and searches for data. The bear case says, if I have an AI agent, an advanced version of ChatGPT or Claude that can scour the web, read every annual report, and synthesize that data for me instantly.
Why am I paying $20,000 a year for a Capital IQ terminal?
That's the question. It's the deflationary pressure argument. If the cost of retrieving and analyzing information drops to near zero because of AI, what happens to S&P's pricing power?
It could evaporate.
Precisely. If an AI can do what a junior analyst using Capital IQ does, but for pennies on the dollar, the unit economics of those high-priced seat licenses could get completely destroyed. It asks the fundamental question, is data a commodity?
And if it is?
If it is, the price eventually goes to zero.
Okay, that sounds scary. And honestly, it sounds plausible. But S&P isn't just sitting there waiting to be disrupted.
Yeah.
They have a defense. And it all centers around one very specific problem with AI. Hallucinations.
This is the bull case, and it's what they call the grounded moat defense. Generative AI is amazing, but it lies.
It lies with confidence.
It hallucinates, it makes up numbers, it can be incredibly confident while being completely and utterly wrong.
We've all seen it. You ask for a citation and it just invents a court case that never happened, or it creates a financial ratio that doesn't exist.
Now, if you're writing a poem or maybe a high school essay, that's fine. Annoying, but fine. But if you are a bank deciding whether to lend $1 billion to a corporation
Ew.
or a government-setting tax policy, you cannot afford a hallucination. You need truth. You need auditable, traceable data.
And S&P owns the truth.
They own the proprietary data. Remember that 95% stat? The AI models, they don't have access to that. They can't see the private proprietary data behind the firewall. They can't scrape what they can't see.
So enter Kensho.
Kensho Technologies. This was a very savvy acquisition S&P made back in 2018. They were the internal AI division. And they have built something they call the Kensho Grounding Agent.
How does that work? Is it like a fact checker?
Think of it as a chaperone for the AI, a truth engine. When you ask a question, the Kensho Grounding Agent intercepts it. It doesn't just let the large language model guess or scrape the open web.
It forces it to use S&P's data.
It cross-references the answer against S&P's 95% proprietary auditable database. It checks the math.
And the source.
And crucially, it provides citations. It provides traceability. You can see exactly where the number came from. This revenue figure came from page 42 of the company's 10K as standardized by S&P methodology.
That is huge, because in a world where AI creates infinite content, and therefore infinite noise trust becomes the scarce commodity.
That is the entire thesis. In a world of cheap, unreliable, hallucinatory AI content, trusted data becomes more valuable, not less. The premium on truth goes up.
But they're not just playing defense. They have an offensive strategy, too. And I found this really interesting. They're being platform agnostic.
This is so smart. They realize they should not try to build their own massive LLM to fight ChatGPT or Gemini. That is a losing battle.
You're not going to outspend Google or Microsoft on compute. It's impossible.
No, that's a capital incinerator. So instead, their strategy is partner, don't compete. They've announced major partnerships with Anthropic, specifically for a product called Claude for financial services, as well as with Google Cloud for Gemini and with Microsoft Copilot.
So the goal is to be the Intel inside.
Exactly. They want to embed S&P data into all of those models. So if a user asks Claude a financial question, S&P wants to be the engine in the background providing the trusted answer. And of course, getting paid for it.
So if I'm just on my regular Microsoft Copilot at work, and I ask for a detailed credit analysis on a company, S&P's tech could be running in the background, ringing the cash register.
That is the goal. They want to be the truth layer for the major LLMs. They want to ensure that no matter which AI wins the platform war, S&P is selling the ammunition to all sides.
And they're using this internally too, right? To make their own people faster and more efficient.
Oh, absolutely. The productivity gains are a big part of the story. They have tools like Kensho Extract and Kensho Scribe.
Kensho Extract sounds like a dentist's tool.
It's less painful, I promise. It's a tool that processes unstructured documents. They've already processed over 1 billion pages. It takes messy PDFs, legal filings, whatever, and turns them into clean, structured data.
And Kensho Scribe.
That transcribes earnings calls and other audio with incredibly high accuracy. They mention 99% accuracy in the context of the value it provides. Think of the time saved for analysts.
And Spark Assist.
That's their internal coding and content creation tool. They said 2/3 of their entire workforce is already using it. So they're getting a massive productivity boost internally, which should, in theory, help support those high margins over time.
So AI is a threat, yes, but they have a plan. They're using their proprietary data as a shield for defense and their partnerships as a sword for offense.
That is the strategy in a nutshell. And so far, it seems to be working.
Now let's move to Section 4, the growth engines. Because you can't just defend, you have to grow. And S&P has its sights set on a massive untapped market, private markets.
This is the new frontier. We all know the public markets, the stock exchange.
Yeah.
It's transparent. You can see the price of Apple every second of the day.
Right. It's all out in the open. But private markets, we're talking private equity, private credit, venture capital, that is a black box.
It's a $21 trillion ecosystem, and it is opaque, it's messy, and it's completely unstandardized. You have PDFs flying back and forth via email, different accounting standards, different reporting schedules. It's chaos.
The transparency gap.
Exactly. And where there is chaos and opacity, S&P sees a massive opportunity.
So what's the plan? I mean, how do you even begin to organize a $21 trillion mess?
Their strategy is something they're calling Standardization Alpha. It involves integrating 2 key acquisitions they've made, a company called With Intelligence and another one called iLevel.
Okay, break those down for me.
With Intelligence provides allocator data. It maps out the ecosystem of over 30,000 limited partners, or LPs, the people with the money, and the general partners, or GPs, the people managing the money.
Just the who's who.
Exactly. And iLevel is a portfolio monitoring tool. It creates a standardized system for tracking the actual performance of the private companies inside these funds.
So they're trying to bolt those two together to create a universal taxonomy, a common language for this chaotic market.
Yes. And think about the power of that. If S&P becomes the accepted standard for how private equity funds report their performance,
then everyone has to use it.
then the GPs, the fund managers, must use it because the LPs, their investors, will demand it. It creates a powerful network effect.
It becomes just send me the report in the standard S&P format.
Exactly. If they can pull this off, it becomes a requirement, not a choice. Just like a credit rating is a requirement in the public bond market, they want to create the S&P 500 equivalent for the entire private equity universe.
That is a massive, massive ambition. But speaking of credit ratings, there's another growth engine that's less strategic and more just. Pure macro luck. Or maybe inevitability. The maturity valve.
This is a huge, predictable tailwind for the ratings business. There's an $8.2 trillion corporate debt maturity wall hitting the market between now and 2028.
Maturity wall sounds like something that happens when you turn 40.
For a CFO, it might feel that way. In finance, it means a lot of debt is coming due. Companies borrowed trillions of dollars years ago, some of it when interest rates were near zero, and those bonds are expiring. You need to pay them back.
But they don't usually just pay them back with cash on hand, right? They refinance it.
Correct. For the most part, they issue new debt to pay off the old debt. And guess what you need when you issue new corporate debt?
A credit rating.
You need a credit rating. Every single one of those refinancings requires a rating. So this $8.2 trillion wall is basically a guaranteed stream of customers walking through S&P's front door, regardless of whether the economy is booming or busting. They have to refinance.
It's a forced buyer mechanism. I love it. Okay, so we've got the business model, the spin-off, the AI strategy, and the growth engines. Everything sounds great. So why in the world did the stock tank 17%? Let's get to the ugly part. Section 5, the financial realities of Q4 2025.
It was a classic good news, bad news situation, but the market, as it often does, focused entirely on the bad.
Okay, let's run through the numbers. Q4 revenue came in at $3.92 billion. That actually beat the consensus estimate, so people are buying the product.
Demand is there, the top line is healthy, but the adjusted EPS, the earnings per share, was $4.30. The consensus on Wall Street was $4.34.
So they missed by 4 cents.
4 pence. That was a tiny miss. 4 cents on a $4 plus number. In isolation, that would not tank a stock 17%. Not even close.
No way. So it had to be the guidance.
It was absolutely the guidance. They issued their full year 2026 adjusted EPS forecast, a range of $19.40 to $19.65.
And what did Wall Street want to hear?
Wall Street's consensus was expecting $19.96. So the midpoint of management's guidance is about 40 or 50 cents below what the analysts had modeled.
Okay, half a dollar in a $20 stock. That's more significant. Why are they guiding so low? I mean, is the business actually slowing down?
Management used that word again. Prudent. They claim they are being conservative. There are a few reasons. First, some of their revenue is volume-driven. Things like bank loan ratings can be unpredictable. So they don't want to promise a boom and then miss it. The old under-promise, over-deliver strategy.
Exactly. Second, there's a tax rate headwind. They expect a higher effective tax rate in 2026, which eats directly into earnings. That's not an operational failure, it's just math.
And the complexity of the spinoff probably plays a role in that caution, too.
Definitely. When you're ripping a company in half, it creates noise and uncertainty in the models. And management explicitly said they're making conservative assumptions. For example, for the ratings business, they're assuming issuance growth of just low to mid-single digits.
Which seems really, really low given that $8.2 trillion maturity wall we just talked about. Right. That is the disconnect. The analysts see the wall and think high growth is coming. Management sees the same wall but says, let's be careful. Let's just model low growth for now. If that wall triggers the refinancing boom we expect, S&P will crush these numbers.
And what about for the indices business?
For indices, they're assuming 5 to 7% market appreciation. That's a pretty standard, safe assumption for any given year.
It is. If the market rips 20% higher, again, they will beat this guidance easily.
Very easily.
So the sell-off is essentially the market throwing a tantrum because management refuses to get over their skis and promise the moon.
That is a very fair assessment. The market hates uncertainty, and conservative guidance often looks like weakness until it's proven to be sandbagging.
So that brings us to the verdict. Section 6. We are looking at a very high-quality company that just went on sale. What does the valuation look like right now after this drop?
This is where it gets really interesting for the long-term investor. The post-earnings drop pushed the forward price-to-earnings ratio, the PE, down to about 26.7 times.
Is that cheap for them?
For a company of this quality, with these moats and margins, yes. Historically, they trade closer to 30 times forward earnings. So you're getting a significant discount relative to their own history.
And the balance sheet, any danger there?
Fortress. Strong balance sheet. And they are incredibly shareholder-friendly. Since 2022, they have returned about 145% of their free cash flow to shareholders through buybacks and dividends.
145%? How do you return more cash than you generate?
They were using their balance sheet, taking on a little debt to do it, yes. But going forward, the new target is to return about 85% of adjusted free cash flow. Still a very, very healthy return of capital to shareholders.
And the strategic outlook. The source analysis we're looking at rates this a strong BUY.
The thesis is simple, really. The market is overreacting to a conservative guide. Meanwhile, S&P Global is doing all the right things strategically. They are cleaning up the portfolio by spinning off mobility. They are deepening their moat with the private market standardization initiative. And they are successfully defending against the AI disruption with Kensho and the grounding agent.
It feels like one of those classic moments where the price disconnects from The value? The price is down because of a short-term guidance number, the long-term value, the moat, the utility status, that's completely unchanged.
In fact, you could argue the value is actually increasing as the information utility becomes even more essential in the age of AI.
So let's wrap this up. Recap time.
S&P Global is shedding its old conglomerate skin. It's becoming a pure-play financial intelligence beast. The dip we are seeing this week is very likely an irrational, short-term reaction to prudent guidance. And the AI threat, while real, is being managed effectively by positioning the company as the indispensable truth layer for the global financial system.
I want to leave our listeners with a provocative thought. We talked about standardization alpha.
Yes, in private markets.
Think about what S&P did with the public markets. The S&P 500 is the market for most people. If they can do the same thing for private markets, if they can become the official ruler that measures that entire $21 trillion ecosystem, then the current valuation might not just be cheap. It might be fundamentally missing a massive multi-year shift in how the global economy measures value.
If they become the currency of private equity, the upside is.
Yeah.
It's hard to quantify. It's enormous.
It's not just about selling data. It's about owning the standard.
Precisely.
Thanks for diving deep with us today. Remember the golden rule: risk defined, portfolio protected.
See you next time.